Hello everyone, this is Tejashwini Gowda, and in this classes we are going to revise about income from house property. Okay. So first of all, when it comes to the term income from house property, whatever the return which you are getting from the house property will be taxable under the head income from house property. In order to understand what income will be taxable, first you need to understand the base term of house property over here. The definition being very simple, what it considers is that building or land. Building means not only residential building, it covers the residential building, commercial building, factory, outlets, premises, it includes go downs, everything. Land for that matter is only going to be land which is connected to that building like garage or garden, etc. It's not just a vacant land which is being considered. Remember, assessee should always be the owner of the property. He should not be a sublessee for that matter. He should be the actual ownership. He should be having the possession of that property. That fellow should be the owner of the property. And the owner and the property, whatever the owner is having, he shouldn't utilize it for his own business. That is what should not be used by the owner means. If he is using it for the purpose of self occupation, it is considered under house property. If it is using for the purpose of business, then it's not going to consider it as your house property. Property which is held as a stock in trade. People try to understand this point. Okay, if you're having a flat for that matter, that is, if you're constructing an apartment, there will be many flats, right? And those flats, if you are having the certificate, that is, if you have got the completion certificate, suppose let's consider on 30th 9 2021, you have got the completion certificate. Clear? From the end of this financial year in which you have got the completion certificate, that is 31st March 2022 is the end of this particular area, that is 21-22. From the end of this year till the up 2 years, from end of this year up to 2 years, what you're going to do is that up to 2 years, whatever this flats which is left vacant, it is not yet sold, people, it is left vacant. Those flats up 2 years, you're going to consider the house property, that is house property value, annual value as nil. What is meant by annual value? We'll try to understand it very soon, okay, in this class only. It is going to be what? Nil. So now, up 2 years, that is till this point of time, considering the year to be 22-23 and 23-24 in this, in my example, it's going to be your house property shall be considered as nil. Beyond 2 years, you're going to call it as DLOP, that is deemed to be let out property. What do I mean? Up to 2 years from the receiving of from the end of the financial year in which you have received the completion certificate, from up to 2 years, your annual value will be nil. Beyond that, if it is still vacant, we are going to classify it as DLOP, deemed to be let out property. Okay. Now, if I'm speaking about the next part, that is being the composite rent, what might happen, people? Some some house property owners might give their flats along with some other assets also. Like if you want to come and stay in my premises, I will say, along with this one, I also have the facility to give you the furniture, the sofa, AC, washing machine, fridge, everything I'm going to provide you. Clear? This is other assets which I'm providing along with the house property. Now comes the question, to what extent I can make it as taxable or not taxable? Under which head it is going to be taxable? See, if it is inseparable, that is, you are coming and asking me for the house property, I am telling you, Array, if you want to take building also and asset also. You are telling, no, 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 I just want a building, I don't want asset. This house property is good, it is near to my office location, it is very good. I just want the building, house property. I am telling you, no, no, no. If you want, take building and asset. If you don't want, I'm not going to give you both. So in this case, I'm going to make it as inseparable. In this situation, can I say my intention is to do business, not to just to give the property on rent. If this is the case, what I will do is that business income, whatever I'm considering, whatever inseparable letting which I'm doing right now, I'm going to consider it as my business income or income from other sources depending on my flexibility. If you're coming and telling in the second situation, ma'am, can you please let out the building alone? I'm telling you, okay, take this building alone. You don't pay for the asset. I am letting you separately the building and the asset based on your wish. In that case, my intention with regarding to house property letting out will be taxable under the income from house property, whatever the money which I'm collecting. And if it is in the case where it is letting out of other assets, that is furniture, furniture, sofa, washing machine, fridge, whatever I'm letting out, AC, all these will be considered as your PGBP or income from other sources as applicable. Income from other sources or PGBP income is what? Clear? Now, next, before getting into the discussions of the GAV gross annual value, let's try to see the computation and come back very soon. Here, the format of income from house property goes something like this. That is GAV, gross annual value. What is it? We'll try to understand very soon. House municipal tax, you're going to reduce the municipal tax. Next, you're going to get your net annual value. Deductions under section 24 is what we are going to understand. Then standard deduction at the rate of 30% of the NAV. Interest on the borrowed capital and the income from house property computation. Clear? Next, see, whatever you are seeing, this is the basic format and this is what is there in income from house property. It's a very, very simpler concept. We are doing the revision right now, so we'll move forward with the next discussion. Whatever the computation of the GAV, gross annual value, in order to determine what is this gross annual value, let's try to understand what are the steps that we are going to consider. Remember, whatever this GAV we are doing, this is for the let out property and deemed to be let out property. More about the deemed to be let out property, we are going to do that discussion going forward. Okay. Now, in case of let out property and deemed to be let out property, first of all, try to understand. In case of your step number 1, in order to compute your GAV, the step number 1 would be to compare the fair rent to the municipal rent, whichever is higher. What is meant by fair rent? The rent which is there in your locality. So, suppose you are charging 20,000 rupees for 2 BHK. Your neighbor is charging somewhere around 20 to 25,000. You are also trying to set that 20 to 25,000 as the limit. So, in your locality, in your neighborhood, whatever the fair rent which is running, that is called as the fair rent. FR is fair rent. Municipal rent means the rent which is determined by the municipality as per your location wherever you're staying. You have to consider whichever is higher as your step number 1 answer. Okay. Whatever the answer which you got in your step number 1, you are going to take that as first part in your step number 2. Or SR is going to be standard rent. Standard rent is the rent which is controlled, that is which is rent, which has been specified under the Rent Control Act. Okay, it is just going to be whichever is lower. Next, this step number 3 would be the answer of your step number 2 or your expected rent. Whatever the answer which you got in your step number 2, you are going to consider that. But answer in your step number 2, we are also going to determine it as your expected rent. So what is the rent that you are going to expect? Okay, or your actual rent always remember you are going to subtract your unrealized rent. URR here means unrealized rent, that is unrealized rent minus your actual rent minus your unrealized rent. You're always and always going to subtract that. Out of these two, whatever the answer which you're getting will be whichever is higher. Whichever is higher would be considered as your answer for your final answer for your GAV will be your this. That is your answer which you're getting from your expected rent or your actual rent. Actual rent should always be subtracted with the unrealized rent. Be careful, whichever is higher. Always remember this is going to be high, low, high. It is not going to be other way around. Please remember this high, low, high. Okay. Whatever discussion which we have made, this is for LOP and DLOP. Very well, fine. But for remember people, but for the purpose of SOP, that is self-occupied property. LOP is let out property. DLOP means deemed to be let out property. SOP means self-occupied property. LOP means you have given it on rent. DLOP means even though you have given it on rent or not, it is deemed as per the provision that you have given it on rent. SOP is going to be self-occupied property. Just so in case of this is going to be your self-occupied property. In case of this is going to be your LOP, let out property. In case of your self-occupied property, remember people, this self-occupied property is going to be your GAV for the purpose of self-occupied property is always going to be nil. See here, whatever you are calculating, this is for the let out property, right? Let out property means LOP, you're going to collect the rent for that matter, people. Self occupied property means you yourself are staying. Are you pay rent by yourself? Not possible. So, as this is self occupied property, you're not going to receive anything from that property as your income. So, your gross annual value for that house property where you're staying over there as residential purpose, it's going to be nil. Okay. Try to understand something. If I'm speaking about the GAV for your, let's consider for this let out property. Let's consider your actual answer for the last point is going to be 5 lakh. Just keeping it very simple. Okay. Now, if I'm recording it 5 lakh over here, this is for LOP and this is for SOP. Okay. First of all, for SOP, you don't have any gross annual value, so that it is going to be nil. For SOP, let's understand that it is going to be what? 5 lakh rupees for that matter. Now, let's try to understand for what is meant by municipal tax. Understand something, people. Municipal tax is something which you are going to pay, which you are going to pay to the municipality. This is municipal taxes, property taxes. Always remember, whatever is the municipal tax paid during the PY, paid during that respective PY, the PY which is relevant is 23, 24 in my point. Whatever you have paid in that respective PY, it is going to be considered as your, it is going to be considered as your municipal taxes deduction for that respective PY. Suppose you have paid your municipality tax in the year PY 23-24 for 22-23 also you have paid in 23-24 only. You forgot to pay in 22-23. You pay 22-23 ka municipal taxes in the year 23-24 along with it. You are going to get the deduction of entire 20,000 for PY 23-24. Because you are going to get the arrears, whatever is the arrears that you are paid as the municipal tax, entire thing you are going to get the deduction. See, think people, there's a logic behind that. What the department or the income tax act wants is that you should show that income. If you're ready to show that income, we will give you the respective deduction as the taxes, whatever you are paying as municipality taxes. Correct. For the PY 23-24, you are going to show the income for LOP. You will get the deduction also. For PY 22-23, you did not get this deduction because you did not actually pay it, but you have already offered your income for taxes in 22-23. You did not show that income here. You have already shown that income. So, if that is the case, you have already done your part of paying the taxes, showing the GAB, paying the taxes. In that case, you have paid income tax. In that case, you are paying the municipal tax of the PY for the income which is already offered to tax. We'll do one thing. Don't worry, we will also give you deduction for PY 22-23. Take it and enjoy. Now, whatever the enjoyment now the people are doing is 20,000 rupees, whatever the arrears they are paying, they will provide. Now comes the question, ma'am, what about the 24-25? That is, this is paid in advance, correct? Whatever the advance payment of PY 24-25 you are making, remember this 24-25 ka advance payment, whatever you are considering over here, it is always and always going to be 10,000 rupees you paid it in advance. In this case, always remember, try to understand the same logic which I had explained before. Are 23-24 ka income, whatever is that, you're already recording, you're already showing it as income in that same PY. 22-23 already shown. Tell me, for 24-25, have you shown your income, offered your income in PY 23-24? No, right? So, if that is the case, if you're not showing your income now, why will we provide the deduction for that matter? They will never provide, people. If you're ready to show your income, then only we are going to provide you the deduction. For 24-25, whatever the rent which you are going to collect, that will be shown in 24-25 only. Why you will show in 23-24 itself? So, whatever the advance municipal tax paid, that will be allowed in that respective PY only. It is not going to be done. So, in your exam, if you are going to get any arrears of municipal tax paid in present PY, take the complete amount because it is going to be actually paid. Remember, it is not payable, it is paid. Paid means money moving out of your bank account, money moving out of your cash moving out of your pocket. That is what it means. It is not payable. Outstanding is not considered. Okay. Any advance coming into picture, please ignore. You're not going to consider it as deduction. Any arrears provided, please consider. Okay. Actually, if it is paid by the assessee for that matter and during the PY, during the previous year for that matter. Clear? That too, during the PY it should be paid and it should be actually paid. See, municipal tax is paid in advance is not allowed in the PY and it is paid. Okay. So this is about your municipal tax paid. Now what you have done is that municipal tax paid you have provided. Remember people, let's consider 20,000 is the municipal tax paid for this LOP property and the annual net annual value is going to be 4,80,000. It's going to be 4,80,000. Clear? Understand one thing people, for SOP there will be no municipal tax paid allowed. Because you're not offering any income only, why will the department or the Income Tax Act gives you any deduction for that matter? If you're ready to show your income, we will give you deduction. You are not ready to show your income, we will not give you any deduction. Simple. So your NAV will also be nil. Now, what happens is that you have to consider the deduction under section 24. Correct. This is a very, very important section. Remember the section number as well, section 24. Section 24A states that standard deduction at the rate of 30% of NAV. What do I mean by that? Very simple. See, this standard deduction at the rate of 30% of NAV means your net annual value for the purpose of computation. Whatever the answer which you are getting over here, in my example, 4,80,000 rupees was there, no? 4,80,000 multiplied by 30%, whatever the answer which you are getting, that will be considered as your net annual value. Clear? Sorry, that will be considered as your standard deduction. Remember, standard deduction will be at the rate of 24, will be under section 24, subsection A. The annual, the rate is going to be 30% on NAV. That 30% is flat, people. Amount is not flat. The percentage is flat. 30% flat of NAV. Flat amount. No 25, no 20%, nothing. Flat 30%. Standard deduction. So now, when it comes to this, the reason behind providing the standard deduction is going to be very simple. See, when it comes to house property, you will be incurring some repairs, you will be incurring some expenses, you'll be incurring some maintenance, some ceiling charges, some floor charges, some small repairs you might be getting. Even though you incur expenses, don't incur expenses, whatever it might be, we are going to give you a deduction, standard deduction of 30%. Take it and enjoy for life. That's it. So, whatever 30% you are going to get, you are going to make it as deduction in your LOP. However, you don't have any NAV in SOP, so it is going to be nil year also. The very important discussion comes under section 24B, that is interest on borrowed capital. First of all, what is meant by borrowed capital is nothing but the loan, people. Loan which you have taken for the purpose of acquisition, construction, renovation, reconstruction, or alterations of any, in case of your house property only. Borrowed capital here means it is going to be under your house property only. Okay, interest on borrowed capital. Now you need to understand something, that is, there is something called as interest on borrowed capital in case of pre-construction interest and you have a post-construction period. Okay. See, let's try to understand the loan construction starting date or the loan, whatever is the borrowed date. Sorry, construction start commencement of the construction or the loan borrowing date. Let's keep it very simple on 1/4. Remember, for the purpose of calculating your pre-construction interest, it has to be loan borrowed or the construction commencement date, whichever is later, whichever is later. For simplicity purpose, I've just considered 1/4/2020. Okay. From this period, let's consider the construction has been completed on 30th 9 2023. So now, whatever the period which you are going to consider from this and this, general sense, general common sense, if you utilize, it will be, this is what you will consider. Right from 1/4/2021 to 30th 9 2023 will be the pre-construction period. Just give. Will be the pre-construction period. Correct? Now, with regarding to that, whatever the pre-construction period which you are getting over here, the pre-construction period which you are getting over here, there is a small point, a small picture that you need to consider with regarding to your Income Tax Act 1961. See, Income Tax Act states that whatever the pre-construction period interest which you are going to consider, remember it is interest people, not the principal payment. Govinda, not a principal payment. It is going to be interest only. Right from the date of construction, starting of your construction or the loan borrowing date, whichever is later, starting from that date till your 31st March of the year in which, preceding the year in which your construction or your construction is completed. Your construction is completed on 30th 9 2023. That immediately preceding 31st March is going to be 31st March 2023. Right from the date of loan construction date or loan borrowing date, whichever is later, till this period, it is going to be called as your pre-construction period interest, which you can take it for the purpose of consideration as deduction. Right from this day to this day. Okay. So let's consider, let's imagine the interest which you have paid in this period is going to be 1 lakh and 1 lakh. Okay. 1 lakh is the interest that you're paying per annum. Let's consider 1 lakh interest you're paying, 1 lakh interest you're paying. So now whatever the 2 lakh rupees interest which you're considering from 1 for 2021 to 31st March 2023, this will be divided by 5. That is 1 by 5th is what we call it as. We are going to divide it by 1 by 5th. 1 by 5th will be allowed as deduction right from the PY in which your period of construction is completed. Right from the PY in which your period of construction is complete. Everyone, clear people? Right from the PY in which your period of construction is completed. So, if I'm speaking about the PY, it starts from PY 23-24. It starts from your PY 23-24 and it ends in your PY and it ends starts from your PY 23-24, 23-24, 24-25, 25-26, 26-27, 27-28, 5 years. It is going to be considered for 5 years for that matter. It starts from PY 23-24, it ends till that time. Clear? Now, if I'm speaking about this deduction is spread over for the period of 5 years, that is 1 by 5th being the installment rate. 1 by 5th being the installment time. So now this is the pre-construction period. When it comes to your post-construction period, whatever you're paying as interest, paid or payable as your interest in that respective PY starting from the period of commencement, that is completion of your property, entire year interest will be allowed as deduction in the same year, paid or payable. Now it is not necessary for you to make it mandatorily as pay. Clear? No. So this is about the interest. Whatever the interest we have spoken about is the total interest calculation. Remember, for LOP and DLOP, your mandatory all the interest, entire interest will be allowed as your deduction. Entire interest will be allowed as your deduction. Whatever amount you pay, whatever amount is payable will be allowed as deduction for LOP and DLOP. Remember, for SOP, it is going to be certain conditions need to be satisfied. In order for SOP to be satisfied, in order to take the maximum deduction of under your SOP, it is going to be 2 lakh rupees for that matter. You have to satisfy 3 conditions. The first condition is that, first of all, loan, whatever the loan which you're borrowing, it should be for the purpose of construction or the acquisition of the house property. Second, it has to be taken on or after 1/4/1999. Third, it has to be completed within the 5 years from the end of the financial year in which your loan was borrowed. So now if I'm speaking about it, if I'm borrowing it under this period, that is the loan is taken on or after and construction acquisition is completed within 5 years from the end of the financial year in which the capital was borrowed. Suppose let's consider the capital was borrowed on 30th of October 2019. Just keeping an example. On this date, the loan was borrowed, the end of the financial year in which, within 5 years from the end of the financial year. The end of the financial year for this matter will be 1920, 31st March 2020. From this year, it has to be your house property construction should be within 5 years, starting from 2021, 21-22, 22-23, 23-24, and 24-25. It has to be for 5 years. If it is for up to a period, that is, if your house property construction is completed within the period of 5 years, then what you're going to do is very simple. You have satisfied all the conditions. Remember, people, this is going to be and clause. This is not going to be or clause. Okay. All the three conditions need to be satisfied in order to take a maximum deduction of rupees 2 lakh. All the conditions satisfied, you will take 2 lakh. If none of the conditions are satisfied or any one condition not being satisfied, you will get a maximum deduction of 30,000 only. That is, again, where the loan is taken for repair, renewal, reconstruction of house property, maximum you are going to get 30,000. This is, remember, this is in case of your self-occupied property. Clear? Now, when it comes to your 115 BAC, remember, interest portion, interest on the loan borrowed for LOP is going to be fully allowed even in case of your 115 BAC. 115 BAC doesn't allow the interest. No deduction will be allowed under section 24. That is, interest on borrowed capital. Whatever calculation we did, it will not be allowed for self-occupied property only under section 115 BAC. Very, very important point, people. The only difference when it comes to 115 BAC and the normal provisions is going to be your self-occupied property interest part only. Your LOP and DLOP is not going to be changed. It is going to be same. This is going to be very, very important. Then now, when it comes to your DLOP, let's try to understand a small point with regarding to it. Remember, if you're having more than two self-occupied property, you are going to consider more that as your DLOP. What do I mean? Suppose you are having some five self-occupied property. Okay. Any property, any order, any property for that matter, two, one, two. Two property, you can consider it as your self-occupied. Three or more properties. Suppose in this case it is five. Any two properties shall be self-occupied property. Remaining three properties you have to assume, even though you have not given it on rent, you have to consider it as your deemed to be let out property. Clear? That is, owns more than two self-occupied property, you have to consider the GAV. Up to two properties, you can consider your GAV as nil. Because SOP, if I'm treating it as SOP or GAV is always going to be nil. So I'm written that. If it is more than that, then it is going to be deemed to be let out property. Remember, GAV is going to be your expected rent. Why is your GAV expected rent? Very simple. In case of your property, you have not given it on anyone for rent. Your actual rent for that matter is going to be zero only, no people. So your expected rent is what it would be remaining. That too, it is whichever is higher. So your expected rent, I've just written it directly as your expected rent and closed. Okay. Remember one thing. In case of your self-occupied property, up to say two self-occupied property, you can consider it as your uh, SOP and GAV will be nil. Beyond two, it is going to be completely your DLOP, and all the LOP provisions, let out provisions will be default by applicable to be will be applicable to the deemed to be let out provisions, deemed to be let out property as well. Clear? And another important discussion, if you are getting any unrealized rent which was subtracted over there, you remember people, here we have discussed about all the unrealized rent we are going to subtract from your actual rent. Whatever is the unrealized rent that you have to consider over here, that is going to be your, that unrealized rent, some after some 4 years, 3 years, that fellow came all of a sudden and gave you the amount. Whatever is your unrealized rent which you are receiving, you have to consider it for the purpose of taxation. That is, it has to be receipt. That is taxable in the year of receipt for that matter. Whenever, whichever year you are going to receive, even after 10 years also you are receiving that unrealized rent, make it as taxable in the year of receipt. You are going to get 30% deduction, whatever standard deduction you got over there. No, the same standard deduction you are going to get over here also. And it is going to be taxable, even though you might say, Array, as you did not give the rent, I did one thing. After some 3-4 years, I sold the property. Even though you're not in the possession of that property, when you have received the rent, still you are going to make it as taxable. That is taxable even if you are not the owner of that property. Clear? Remember, in case of you owning you are having the co-owned property, for your self-occupied property, each individual is going to get the deduction of 22 lakh or 30,000, depending on satisfying of your condition. If there are two people being the co-owned property, having the co-owned property, both the people can take the interest deduction of up to 2 lakh and can take the deduction of up to 2 lakh and 2 lakh. Clear? So now, you can take up to 2 lakh and 2 lakh. Now, when it comes to your let out the property, remember, in case of your let out property, it is going to be, however, all the interest, entire interest allowed, paid or payable is going to be completely allowed. Same thing will be allowed here. Okay. This is about your income from house property revision. Thank you.